Okay.
It's going to be on the main channel, so I don't know if anybody will pop in or not.
Sweet. Where the fuck? I'm missing it. Where am I? Is it below? God, there's so many. Where is it posted at?
I just posted a link in the general in the chat
Oh,
tab.
sweet. Thanks. Why the fuck can I not? I'm not seeing announcements on my thing. Oh, maybe the. Yeah, my announcements thing is like gone. Oh, there it is. Okay. Sweet. All right, let me go share my screen. Green screen. Okay.
What are you working on?
Well, I just wanna do this announcement real quick about the community contest. So everybody can see my screen, right?
Yep.
Okay. So this was posted by Arlie, Q1 Stock Strategia Showdown. Okay, so basically the rules are maximum drawdown in below 20%, ETFs and ETNs only, no single companies. Leverage is allowed and encouraged. All right. Um, Maximum of 10 if else branches and 4-year backtest minimum. If it starts after January 2020, it's no bueno. Competition structure, 5 strategies per person. Highest annual return wins. Returns are calculated by taking the length of the backtest and removing the highest returning year, and then averaging the remaining years out. The contest will run until March 31st, and submissions will be taken from the thread linked above. Um, so I'm guessing that's this link right here, Q1 Stock Strategist Showdown.
Is the goal of removing the top performing year to get rid of the the COVID effect, where so many strategies explode during that time specifically?
Probably, yeah. That would be my guess. That would be my guess. Let's see here.
Just
So,
started in May.
say
Started
what
like
now?
May. Just started like May of 20 or whatever. I don't know.
Well, yeah, we can't because then it's not a 4-year backtestable strategy. Or you could start at 2015 to 2019. But that's kind of pointless though. Um, Close this real quick. See, like now I can't see the count of how many people are on the call because my name is too freaking long.
There's 16 or so. That's what, at least when I joined there was.
If you go to the
What?
event,
You're super quiet where
What's
it
that?
is.
is that better?
You're still better.
Let's see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 5, 10, 15, 14, 15, 16, 17. All right. Well, I'm gonna jump into what I wanted to cover real quick. So, um, I want to talk about momentum trading or trend following as a way of building a strategy. Um, I think what I'll do is, as I'm doing some of these calls, I'll kind of go over maybe the different ways that we can trade inside of Composer. Um, the biggest one thinking is probably momentum trading or trend following is going to be the most likely way to make the biggest percent of gains, or maybe the longest trending periods of being in a strategy or stuff like that. So I just have the SPX, which is the S&P 500 index, on here, and I'm just going to kind of go over like a long-term trend, maybe a short-term trend, um, how to spot a trend, and then sort of the benefits of trading with momentum or trading or trend following, and then sort of the drawbacks. But just to start, I just have the 200-day simple moving average on here, which is the orange line. And so kind of how I first got into trading was using this 200-day moving average, and I got it from a trader named Chuck Hughes. He's one. I think he runs one of the bigger funds, but anyway, they use a 200-day or a 10-month simple moving average trend following strategy to sort of buy companies, ride the momentum, and then basically get out of them when the trend starts to turn around. So there was an interesting. See if I can. I'm going to pull up this. I took a screenshot of a book that I'm reading right now, and the book is called "Trade Your Way to Financial Freedom" by Van Tharp. Let me link. I'll link the book in the chat. Oops, trade your way to financial freedom. So it's this book here. But there was I was reading it today when I was on the plane, and funny enough, I came across a little paragraph when he's addressing trend following, and I'm gonna post the screenshot in the chat. But basically, he says an old trend follower who'd made millions trading the market once told me that he would take a chart of the market, hang it on the wall, and walk to the other side of the room. If the trend of the market was obvious from the other side of the room, then it was a market that he would consider. The old trader's style had a lot of merit in the 1960s and 1970s when there were a lot of long trending markets. Although the principle behind it is still valid, shorter criteria might be more appropriate now that the market trends tend to be shorter. Generally, people make money in up markets or down markets. However, there are really three directions in which the market can move: up, down, or sideways. Markets tend to move up or down significantly about 15 to 30% of the time. The rest of the time, they move sideways. You need to be able to assess when those conditions occur. For example, a lot of traders have systems that constantly keep them in the market. However, if you accept sideways as a condition of the market, then you probably want a system that will keep you out of the market the 70% of the time in which you are not likely to make money. You simply need some sort of signal to monitor when sideways is occurring, and then it goes on. But it's really important to remember that, because here, I'm going to post this in the chat as well, just so you guys can see what I'm talking about.
No problem, Pyro. Talking to chat.
You guys can, okay, yeah. Okay, so I posted that screenshot from my phone. So anyway, if you if you look at a chart, you can like if you've got the 200-day moving average on here, you can pretty obviously see when it's trending and when it's not. And so the benefit of trend following is, I'll just scroll to a random place and time. Okay, so like if I scroll here, you can see how the current price is below that 200-day moving average. And so if you're using a trend following strategy like the 200-day, which is longer term trend, you would be out of the market when it's below the trend, and then when the price closes above the 200-day, like it did here, you would enter long, and then the price closes below, so you'd get back out, and then closes above, so on and so forth. So if you're doing it on a daily time frame, these examples here are where you would get whipsawed and you would take a loss. And then again here, you would take another loss, get back in, take another loss. And that's just the name of the game. And that's kind of what speaks to what he's talking about in the book, where the markets trend 30% of the time. Now, if you're somebody that goes short on the flip side, you can make money pretty quickly in downtrending markets, but you need to know when to take your profits out and where to set your stop losses and things like that. But the benefit is not the downside. The benefit is the upside of the trending markets, because even if they have even if they're only trending up 30% of the time, or trending down, the uptrends tend to last for an extended period of time, and you can make a very big gain once the market closes back below that line. So, for example, if somebody got in and then rode this trend and then got back out when it closed below, that's an 18% move, and that would be basically one trade. And then over here, you'd get whipsawed, but over a period of time, the wins are much bigger than the losses. And so that's where the trend following actually plays in your favor. Is, if you can see back here, 1994 all the way to 96, and then again from July 96 all the way to just about August of 98, the market basically stayed above that 200-day and never closed below it. So even though the wins may be infrequent, or it may not trend for a period of time like you see here, you'd get whipsawed here, but then you would make up for all the losses and then some when the market does trend. And so even if you have a strategy that just follows this basic rule, the strategy might only have maybe a 40 or 45% win rate. However, it's still going to net you a winning percentage in terms of your profits. You're still going to have a profitable strategy because the wins on the trend following are much larger than the losses, and the losses don't tend to last very long either. So if I just plug this in and I do current price of SPY above the 200-day move average, buy SPY, other words, sit in cash, for example, one of the benefits is you can run this monthly instead of daily, and you can ride the trends on a monthly basis and not have to worry about the day-to-day price movement. So now if you compare it to buy and hold, it's not going to be as you're not going to have the same moves, or you're not going to end up with the same cumulative return. But that's not the idea of the strategy. The idea of the strategy is to avoid downward trending markets like here, which actually started in the beginning of 2008, and you can see the strategy stays out of the market the entire time. until around June of 2009, when the market starts to trend again. So,
Can't you
for
backtest?
example,
Can't you backtest this to 2003 with Shy? Did you do SHV or Shy?
SHV. Yeah, you're right. Let me do Shy because I should be 2002 actually. Okay, perfect. So let me go back here and I'll move it to where the strategy starts. So you can see as the SPY is whipsawing back and forth and back and forth, it's basically just moving in a sideways market trend. The strategy is just sitting in Shy until the price at the beginning of the month is above that 200-day, which starts right here. So the idea of the strategy is to avoid all of the back and forth sideways movement, and you're just riding a clearly defined trend, and that's the idea. So um, a lot of big traders trade this way, and you can see this right here from May of 2003 to January 2008. That's one single trade right there. Which would have yielded you about a 72% return on one single trade, and then it gets back out of the market through 2008, and then it gets back in 2009. So then from 2009, this is a new trade that's put on, and then the trade or the strategy exits the market there and makes another about a 20% gain. It might be a little different if I zoom in.
Can you try something real quick, Derek? Can you switch that to a 925 ribbon?
Yeah.
Something I've been experimenting with lately is ribbons to smooth out. Oh, you traded monthly. Was that intentional?
Well, yeah,
Okay.
that's just based off the 200. But I can. You want me to switch it to daily?
Yeah, let's do daily and then do a 9 to 25 ribbon. I've been finding that you can smooth out the volatility of the weekly movements with a ribbon,
Mm-hmm.
but you can speed up the switch on the downturns and still get a pretty smooth movement.
Okay. Are you saying 25 or 250?
25 day.
Okay,
9 over
25.
25 ribbon.
All right.
And
Simple moving average
yeah, actually do
okay.
exponential. Do exponential on both.
On both. Okay. So exponential.
Also, do you have a window up on your computer or is that me? Oh,
Mm,
that's me. What the hell is this?
might be you. Yeah, I don't have anything up. Everybody can see my screen, right?
Yeah, no, it's me.
Okay. All right. All right. So 25 daily, and then run.
Okay.
Yeah, very small drawdown. Um,
Yeah, that was try a 35 day. 9 over 35. Can't remember
I know
what.
85 works really good for me. What did you say, 35?
Yeah.
All right, 35,
Yeah.
9 exponential, and then 35-day exponential.
Hanome, I think you're hot micing or
Yeah,
feedbacking.
5 and 20. Yeah, I'm hearing feedback. Yeah, 5.6 and 20.2.
Okay. I'll have to
Sure.
dig it up, but I was experimenting with a strategy that worked really well with the ribbon.
I don't know if 85 exponential. Well, 85 exponential works good too. That's an 8% return with 23. Let me try this one simple.
You can also
8.2.
you can also use
That's strong.
you can also use a long ribbon like a 200 300 or a like a 150 250. And
Mm-hmm.
that tends to smooth out it tends to let like every time the market goes down, it usually consolidates on the bottom for a little bit before it actually
Yeah.
reverses and goes long. And I find that those long ribbons can kind of help smooth, or they help you stay in a like a different strategy for a while
Uh-huh.
until the market actually turns over. And
Yeah, I can actually see it here. 150 and over the 350, higher return and relatively low drawdown compared to the buy and hold. The buy and hold is going to be 55% drawdown because of 2008. Although I'm wondering what the drawdown was in the dot-com bubble, but I don't know off the top of my head. I know NASDAQ was like a 78% drawdown.
Dot-com bubble was 50%.
For the SPY.
I know the housing market crash was 55. I think it was almost identical.
Okay. So yeah, so this is just one example, guys, of doing the long-term trend following to, like Garen was saying, to smooth out the volatility of your equity curve, even if you're just trading a simple strategy like this. And then the other thing he was saying was the shorter term, shorter time frames. I think there's another indicator on here I can use, EMA cross. So to show this example of the 150 and the 350, I'll plug that in on this EMA cross here. Let's see. I'll get rid of these two, and I'll use those two. 150, 350. Yeah, so if you look at, and what he means by smooth out the volatility, this would be an example right here. You can see that these two moving averages never actually touch each other or cross, and you can see the whipsawing of the price action coming up, down, back up, back down, back up, back down. So throughout this whole period, your strategy would have told you to stay long because the moving averages never cross, and you would just endure the whipsawing of back and forth sideways market. And then the nice thing about TradingView is I can go back further than what Composer is showing me. So like here, 1991, you would have a cross down, and the market already bottomed, and then you would have had a cross back up right here. But what's nice is the cross up is already telling you that the long-term trend is upward, and that this was a sort of basically a temporary period of sideways movement. So, and then, yeah, so here too, same thing, because of 1987, of course. So you have a cross down here, and then it doesn't look like they cross over again until maybe right there. So this is, again, like I was saying earlier, this is where the trend following will whipsaw your portfolio, because you have, and if you look at the lines too, the lines are basically going sideways. That's another telltale sign of maybe have other strategies that are doing different things in a period like this, because you're going to encounter prolonged periods of drawdown when the price action is going sideways like that. And then, so the strategy is really only built for strong uptrends like this. And even though, in fact, there's another one. If you're somebody that wants to trade on a shorter time frame, maybe you want to be in and out more frequently, I have found that the 85-day works pretty well on the S&P. Let me run this. So this is a 7.5% rate of return, but with the trend following, you don't need to worry so much about the rate of return, because it's going to be a long-term strategy. What you should focus on more is the amount of drawdown compared to buy and hold, because that's where it's going to save you. And this, you would be in and out of the market more frequently, but still get about the same amount of gains with using the 200-day, but you don't have as large of drawdowns. So you can even do something like that, where maybe you have a short term and then you have a long term, and you just weight them both equally. And one of my favorites is the 8 EMA and the 200 simple. And it looks like this. So like Garen was saying earlier, a lot of times when the markets are making a bottom, you can, instead of using the current price, you can use an exponential moving average that's maybe a short duration, like an 8-day, and this will smooth out the volatility of the market bottoming out. And you can use that as a signal to get in as well. So if you combine these two together, you have a short term, you have a long term, and your annual return is improved, and then your max drawdown actually comes down. So this is sort of the beauty of letting the two work side by side. And then you can always look at the long-term one to see how that bears out. So that gives you 8.9 return with a 19% drawdown. The nice thing is this is all the way since 2002. So this is two extremely bad bear markets within a 10-year period. And then you have a lot of volatility and sideways movement in 2011, and then again in 2015, and again in 2018, and of course COVID and 2022. And if you look at 2022, this is one of those periods where the strategy once again would sort of get out, stay out, and then get back in right as the market is starting to turn around. You're not going to catch the bottom, but that's not the goal. The goal is not to catch the bottom. The goal is to reduce your risk in a downward trending market. So just try to keep that in mind. I know it's tempting to want to try to find the bottom and try to figure out where to go short and blah, blah, blah. But this is just to kind of give a baseline understanding of what the point of trend following is, and how to spot a trend, whether it's a short-term trend or a long-term trend, or even using them side by side like this. In fact, you could even do threshold. Well, this is not going to really matter because they're going to do the same thing, so it doesn't matter. Maybe I'll leave it at like 3. 8.3. What does it look like on the daily? 5. Yeah, so they're going to stay relatively the same. And in fact, I'll just save this and I'll just copy paste it in the chat, and then obviously feel free to mess with it and tinker and all that, because I don't know how many new people we have in here in terms of the people that are joining the calls. So it's a good refresher for a lot of us in here already kind of know this stuff, but a lot of people may not. So this will give sort of a good baseline. I'll just do this SPY, short term and long term trend. Oops. Following. Save. And then I don't know if everybody was on that call where I played the clip of Tom Basso doing the interview with Trader Lion, but basically he showed sort of a graph of the Dow Jones just over the years from, I don't even know if it was from inception, but basically he showed these periods, these down periods, and the graph showed the long-term movement of the Dow. And then he talked about filling the potholes of your portfolio. So basically, if buy and hold SPY was your equity curve, how can you fill in those potholes? Well, first, you can use this as sort of a baseline, sort of overall strategy. And then within the strategy, you can start to implement other strategies that might take advantage of these periods where the market's trending downward and things like that. And then start to sort of layer those onto your portfolio and start to create a nice sort of a steadily rising equity curve for your portfolio. That way you're not having to endure too much drawdown during periods where maybe there's a recession or maybe there's Fed news or Fed fears or something like that, like we had in 2018. But yeah, so that's the whole idea of trend following. And I'm trying to zoom into 2018 here.
And for those that haven't seen
So
it, I actually made an entire guide on asset rotation theory, like when those markets downturn, what assets do you rotate into? There's a write-up on it there with a video if anybody needs to watch it.
yeah, perfect. Let's see. Oh, here. I think it's good to use common averages, so the lemmings will follow you. 200-day moving average, etc. Risk on off switches with multiple time frames also makes an excellent choice. Methinks. Yeah. Yeah. Exactly. And that's why I showed that example of the current price versus the 85-day, and then also the 8 EMA with the 200 simple. So things like that can drastically reduce the the standard deviation will kind of show you what the volatility of the specific strategy is going to do, and then if we actually compare that to S&P, it should be lower. So here's the standard deviation here, and you can see the strategy has a 10%, whereas buy and hold has a 19%. So it's a good way to get volatility out of your portfolio and avoid periods like this. I mean, you're not going to avoid everything, but you're gonna avoid the vast majority. I want to run this through QuantStats real quick because I want to show. It's not going to give me my. See, that's one thing I wish we could do with QuantStats is give you a win rate in terms of, for example, in terms of per trade. Do you know what I mean? Like, for example, it was in bonds here, and then it goes long in the market right about here. So I'm wondering, so this would be one trade here, the bonds, and then goes to S&P, that's one trade, and then it's back to bonds. I wish there was a way to get the win rate per trade in QuantStats. You know what I'm talking about?
So QuantStats will give you a win rate, but you want the win rate per individual trade.
Yeah.
Is that what you're saying? Not like the daily.
Exactly.
Overall.
Right. Yeah. I want the win rate per trade. That's what I'm wondering, because the win rate per trade will tell you. Well, it'll give you a better idea.
You want to have it listed as the win rate picking this particular asset versus this particular asset versus this particular asset. That's what you're saying.
Yes.
So you want multiple win rates.
Yeah. Because I can let's say it gives me the win rate of when it's in bonds. I don't care about that because I'm just using that as a cash equivalent. So I can just write that off and then focus only on the win rate when it goes long in the market. You know what I mean?
Yeah.
Right now, the best way I usually measure that is the profit factor. So here, profit factor, basically it's per $1 risked, you make 16 cents basically or $1.16 per every $1 risked. So whereas buy and hold, you're making 13 cents per every $1 risked, and so on and so forth. So you have a down period in 2022. You have a down period in I think that's 2015, and then 2011 most likely, and then probably 2007. Oh, I guess I could just look at the year, huh? So 2002 minus 0.9, although it wasn't in the market the whole year, started in July of 2002. So if we look at per year, 2003, 25% versus 28%. 2004, 2% versus 10%. 05, 2% versus 4%. 9% versus 15. Blah, 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 blah. Let's look at 2008. 2008, buy and hold, negative 36%. Strategy was actually positive. Where's another big down year? Well, I guess there wasn't a lot. 2022, -18 versus -15. Um,
I'm not sure
30.
if I'm going to be leaving it up, Pyro, but
So, and it looks like it's barely starting to recover
I
from
think Vox is probably
2022.
recording it.
So, yeah, these, another thing you guys could look at too is the underwater plot. So these are every time the strategy has a drawdown period. So if you have like an overall maybe idea of how you want to build your portfolio, you can always start with like the trend following and then look at your drawdown periods and figure out, okay, what's a different type of strategy that I could maybe arbitrage the drawdowns with that might take advantage of the markets. And you could do that through bonds, you could do it through commodities, whatever you can come up with that you can develop an edge with would be a good way to sort of add that to your portfolio. And then this will give you the monthly performance. So each block is a month. This is another thing I like to look at a lot, especially if I'm building out like a master. I'll look at the monthly plots, and then I want to see. So win days, same as buy and hold, 55%. Win months, 64% versus 67. Win quarters, 64 versus 73, and then win years, 82 versus 73. So this is definitely a good baseline to build an overall portfolio off of. But you want to be doing other things during your drawdown periods. And then if you notice here, the Serenity Index on this is higher than buy and hold because you're not having to sit through those bear markets. So that's something to keep in mind. And then the Ulcer Index, which goes hand in hand with the Serenity, is also half of what buy and hold is. So definitely more peace of mind doing the trend following, but this is the where trend following really matters, like I said, is where we have these really bad down periods in the market, and the strategy will just get out. So imagine if it was September 2008, which is right here, and Lehman Brothers collapses, and you're not even in the market, and so you'd be watching all this and thinking, man, I'm really glad I have a trading strategy. So, um, but that again, that's I wonder if I can. Let's see. Chuck Hughes trading strategy. I wonder if this will come up. So this is who I learned it from. The rule-based system is not complicated, but it works. You trade with the trend. When the price trend is up, you buy. When the price trend is down, you sell. It's a basic trade selection process that has produced consistent profit opportunities for Chuck Hughes and the members of his inner circle. So I think he has books and PDFs and stuff that you can buy, but that's where I learned that 200-day moving average from. But like I said, even in the down periods, you can look at shorter term strategies and figure out how to take advantage of the down markets. So there's always that too. Let's see if we got anything else. Picking only one overfits to the past. Yep. Let's see. I took the liberty of adding one more great switch. 60-day simple moving average of TIP. All right, let's take a look at this. Hold on one second, guys. Sorry. So 60-day moving average of return of TIP is greater than the 60-day moving average of return of SHV. Go long on SPY, if not shy. Sweet. When did TIP come into existence? Is it backtestable far back enough? 2007. All right, so let's.
Can you hear me now?
Yeah.
Yeah, you can go back to 2007.
Okay, cool.
You don't have to use SHV either. If you want it to be like really stripped down, you can just use the 60-day SMA of TIP. But comparing it to short-term bonds seems to help a little bit. But what's awesome about it is like it's like a 15% drawdown versus a 55% drawdown on SPY.
Yeah. And because of avoiding the drawdown, you're ending up with a higher annualized return too. So that's awesome.
Yeah, I mean, looking at it all the way back as far as you can go, it's about the same return, but man, the CalMAR ratio is much higher. So yeah.
Yeah, and you still keep the low standard deviation. You have a higher Sharp. You got some alpha on SPY, low beta. So yeah, that's awesome.
Anyway, that's one of my faves.
What's TIP?
Oh, it's just it's like a mixed bag of Treasury inflation protected securities, TIPS. And I think the average duration is like 5 to 7 years or something.
They're used to hedge against inflation.
Yeah, so I guess when inflation gets out of control, these bonds pay you more. But of course, it's tied to the CPI. So you're kind of trusting the government to tell you what inflation is.
It's kind of like it's kind of like the exchange tradable version of I bonds.
Yeah, exactly. Yeah. But apparently they have this. I don't have proof of this in front of me, but I've read in a few PDFs, strategies people put together that you can test this. You can test TIPS going back to the 1970s as an indicator for risk on, risk off, and it seems to hold up going all the way back to basically when TIPS began.
That's pretty cool.
So anyway, it's just maybe I'm spreading rumors, but it does seem to work, right? Going back as far as we can test with this ETF.
Yeah.
If you find a link to that, drop it in the I don't know the stats forum or something. That sounds like an interesting data set.
Are you talking to me or you're talking to him?
No, Hanno. If you can find a link to that showing
Actually, it's I built a strategy around one of the papers that uses it. Let me see if I can find the link, and I'll throw it in the comments here. Give me a minute.
So there's that one, and then I forgot I made this one too. So this one looks at the 60-day cumulative return of SPY, and like Hinnom was saying, this I was also using as like a risk off, and let's see. This in a way kind of does the same thing. Kind of gets out at really good times. So if you look here, this is 07, 08. So it gets out here July 07, gets back in September 07, gets back out November, gets back in, and then gets back out, and then doesn't get back in again until September 2008. And then these are just mean reversion catches there. But as I was scrolling, I was noticing it was getting out at a relatively good time as far as when you had these quick drawdown periods, like this is 2010 and then 2011. So the volatility is insane. You can see this huge freaking it's kind of hard to tell, but you can tell these are big up days, big down days, and the strategy's out the whole time. And then where else did it hurt? I think it happened again 2015. Yeah, 2015. It was out, and then
Have you attempted to take the different a bunch of different moving averages and putting them into a sort function to see if like certain ones perform better at certain times and they switch on and off?
actually no, I haven't. That's a good idea though. Wonder if I should try that. So this one's the moving. I could try. You want me to try it with these three right here?
Sure. I'm just curious. I bet there's certain ones that probably work better during certain market regimes. Depends on the
Yeah,
look
that's probably
back
true.
window.
How do you want me to filter it?
That's a great question.
What comes off the top of your head?
um, maybe relative strength index 20 day, 30, 35 day.
35. Top?
Yeah, start with top.
Top one. I'll do top one. And then copy paste.
Standard deviation, lowest standard deviation would also select the least volatile. You'll get a crazy low drawdown.
Okay. Eight and 30. So we got 1, 2, 3. Okay, yeah. And then what was the other one you said?
Try lowest standard deviation of returns.
Standard deviation of return
Yeah,
over how many days?
start at 35 and then reduce the time frame down. And do like a 35 day, a 20 day, 10 day, 5 day.
Okay. So this is 8 and 30. This is 6 and 16. Yeah, that's not bad. Look what it does in uh is that 2022 or 2023? Here. That's pretty nice.
Try a 20 day and a 10 day.
Kind of like that. Would you say a 20 day?
Yeah.
6 and 16.
And
6 and 16.
And Ohm,
About
when
the
you were saying
same.
earlier, you like using common averages to follow like risk on, risk off, switching multiple time frames. Are you talking about like stacking multiple different switches that are kind of similar?
Is he still? Oh, yeah, he's on here. He might be away. 10-day standard deviation of return, bottom one. 7.8 and 18. That's pretty good.
Try a 5 day, see what that does.
I still can't figure out freaking standard deviation, dude.
It's just a measurement of throttle. Look at it like a throttle on a car. You're wanting the least volatile thing that you're looking at.
Okay.
I don't think you can we weight by a sort function by inverse volatility? I don't think we can.
What do you mean?
Real said weight by inverse volatility.
Oh, try to weight by inverse volatility.
I don't think you can do that on sort functions unless they.
Here? Talking about here?
I think
wouldn't
it'll
make
do it. That won't it do it if it returns equities and not like groups? I know it doesn't work on groups.
Yeah, I don't think it works on groups, unfortunately. That would be nice. That would be very nice.
Yeah.
No, you can do it on groups.
What?
Yeah, you can do it on groups. I've done it on groups, but I don't think you can do it within a sort function though.
You can
Not within
really.
sort, but you can do it in groups.
I didn't know that they added that feature.
It's
On
pretty
Yeah, I
great.
think
on the if
Yeah,
functions?
yeah.
Okay.
Watch. Inverse volatility. let's just say 20-day. And then, yeah, I can copy and paste these and down here. You didn't know that?
I didn't know that you could do it with the if functions. No.
It is relatively new.
Have they officially launched the percentage price oscillator, or is that still beta?
No, it's still beta.
They haven't
Some-
explained why, though.
Yeah,
Yeah, I'm not sure.
It works.
it's a really good drawdown though.
We try like the 60-day
14%.
or even like the 3-day. I got a good work out of those.
On the inverse volatility.
Yeah.
I really, for some reason, like 60-day works well for so many things. 9 and 13. Pretty damn good.
Yeah, fuck sort functions.
That's freaking awesome. What was the other one you said?
Like a 3-day?
Oh, 3-day. Okay.
What if you did a switchboard? So what if you did take the sort function, copy and paste it 3 times, and then do three sort functions like a switchboard, but do like RSI, lowest standard deviation, highest standard deviation, and then weight each. Take the layer 2 is the inverse volatility. Does that make sense? Okay, copy that sort function.
I just froze.
Oh, copy that sort function, and then paste it under the inverse volatility. Like
paste it under here.
No, put it inside of the inverse volatility.
Fuck me. Okay, let me try it again. Paste it under here.
Yeah, just put it in there, and then do 3 or 4 of them. Just collapse them all
in a row.
That should work.
Yeah. Yeah, do like 3 or 4 of them, and then do a bunch of different like RSI top, standard deviation low.
Do I delete this one then?
5-day drawdown. Yeah.
Okay. And then just change all the checks. Do you want me to delete these 3?
Yeah. Yeah, go ahead and delete those. And then just change and then it's basically going to select the lowest inverse volatility of whatever.
Sweet. Okay.
I did not. I didn't know you could do that. That's a good way to hedge. So that's a good way to do a switchboard with high standard volatility or high standard deviation, high volatility, but the inverse volatility will. Well, maybe.
All right. So what's the next one?
Let's do RSI, 30, whatever the best RSI was. I can't remember.
Was it 30? I don't remember either. 20?
I think it was 10 or 20. Do
bottom or top?
Top. Then do a move average return or something.
Moving average of return. Hannah, you said you've done one of these like this? What do you want, 10, 20-day?
Do 20-day. I find 20 days a pretty smooth one. Can't remember if it's top or bottom moving average, though.
I mean, you would think you would want the top, right? The one performing the best.
Not necessarily, because you might be buying the most overextended one that's about to turn down.
That's true. 7 and 20.
Yeah.
Oh, maybe I should change this to 60 or something. Or look at a lower time frame.
Wait, Walter's saying it won't inverse volatility weight what the sorts produce, though. Just the backtest group results as batches. Okay, so it calculates the backtest of the sort function, and then it selects the inverse volatility of whatever one is rolling.
It's doing what now? Sorry.
Did I get that right, Walter?
Yeah. Like I've tried it. Like if you have a switchboard with pick 7 of 10 sub strategies, if you try to inverse volatility weight that with the idea that it will sort the groups that the sort produces, it won't do it. But it will. It'll do. You have multiple sorts like this. it'll do the sorts.
Holy
If that
shit!
makes sense.
The YouTube video channel just jumped to 108 viewers.
Oh yeah,
Yeah, I don't know why.
nice. So Walter, what you're saying is if I change this from inverse volatility to equal weighted, it'll stay the same?
Well, though you're using different sorts. I'd just say, I one time thought that
What's up,
you
chat? What's up,
could
guys?
sort
Still
groups
waiting on
and
Lego
then,
Bill 3 years.
throw that weight on top
There's
of
a
the
video coming
sort,
for
and
that,
maybe it would,
but
weight them differently
you'll
what the
see it.
sort
You'll
produces,
see it.
but it doesn't do that. No, but you've got different sorts going.
Lots
so.
of videos are coming out. I also started a new YouTube channel. It's called Algorithmic Investing with Garen. I'll link it in chat for you guys. But I've been building an online community. This is a
that's interesting.
4,800 man community that
8 and
builds
20.
algorithmic investing
Man, that freaking
strategies
inverse
for
volatility,
trading the stock market automatically. What we're doing
the way
right
we
now
had
is
that
building
first
investing
one's crazy.
strategies.
Because we had
I'll link you guys the new YouTube channel.
Wait. Inverse 60. We had these three. One.
If you guys have any questions, feel free to let me know in chat. Today I'm going to walk you through my algorithmic investing portfolio.
No, just delete the rest. Nine and 13. That is freaking nuts. 9 and 13.
Oh, BT22, I remember you. Didn't you used to jump into my... Wait, it might still be...
Okay, so it's pretty much all
Didn't you used to jump into my live streams? Like way back in the day, in like 2018 when I was day trading?
Are you guys recording the call by chance? Or is anybody recording it?
I've got it recorded on YouTube.
Oh yeah, I forgot you said you were doing it live, right?
Yep.
Okay.
Is that simply to avoid the complexity of getting OBS working?
Oh, it's running through OBS. I got
okay.
I got my YouTube link to OBS.
I like OBS, but it's just freaking every time I start to record it while I'm doing a call, it's just like all I can hear is the fans running in my computer.
Yeah, OBS is a great software, but it took me a long time to get good at it.
It's like
all the settings, all the like bit rates and everything. It's like a whole learning curve.
Yeah, I have no idea how to use it other than to like record the call.
Yeah, there's no presets for like, simple stupid.
This on its own right here is really solid.
Yeah, I really like that. I now I want to take all the FTFL variants and do this.
Oh, you know what you could do is go to that what is it? The
Yeah, I got you, Walter.
Let's see.
Actually, I can't see. I got stream mode in, so I can't see people's names.
Evolution yeah, this here. Because you could all of the evolutions of it. I could weight those, couldn't I?
Of the FTFL?
Yeah.
Yeah, you could do the lowest inverse volatility of every single one. There's the YouTube stream. That's my main channel. Probably should put that in general chat for anybody that wants to watch.
Inverse volatility. This is going to be tricky. 15 days. 42, 38. That's nice. It just gets the hell out. 20, 42, 38, 38, 42. The numbers switched. It's funny. 38, 42, 42, 38. So I wonder if 49.34. I think it's just this one is going to just sit in SHV while TQQ is below its 200-day. So it's always going to select this one during any bear market. And you can see that there. So it's just sitting there and then getting back in. Although
Walter
this
says
one
try
is
something
new.
high, like 60.
Say again.
Try 60-day volatility.
60? I think that's what I started with.
Derek,
33.
another thing, another suggestion I have for you, Derek, when you've got a big list of strategies that you're sorting through. So inverse volatility is a nifty one, but also I like to use moving average return, but comparing that whole list against Bill. In other words, what you're doing is a dual momentum kind of search. You're basically forcing a filter which is looking for positive momentum. You're looking for, which one of those, let's say 6 or 7 strategies is producing the highest return, but also that return must be positive. It must be, compared to Bill.
That makes sense, yeah.
So you put Bill
Because
in the inverse volatility or in a sort function?
You put it in a sort function where you're looking at moving average return or cumulative return.
Okay.
And you would think you could do the same thing with max drawdown, but for some reason it doesn't seem to work very well.
Max drawdown is triggered, and it holds the trigger until the trigger is off. It's off. They do it a fucking weird way, and I've tried to get them to switch it to like how drawdown would work logically. It's not like an underwater plot.
Okay, so if it's not right, that would explain why that moving average works so much better, or produces different results.
Yeah, because originally I wanted to do a martingale strategy off of like a really long, like 400-day look back, and I wanted to do like the .com bubble and the housing market crash, and I wanted to say like martingale, when you hit 25% losses, go into 2x leveraged up, and then like at a 40% loss, go into a 3x leverage up. So it actually, the more drawdown you get, the heavier your leverage.
Garen, hold on. You're getting a ton of echo. I think that's you.
It's
probably.
him.
I think it's Hinham.
Yeah.
Oh.
Yes. So that doesn't work, because if you do a 400-day look back on drawdown, it will, once it triggers, it takes 400 days for the trigger to come off. So you can't do it.
I'll guys, I'm going to be right back. I'm going to call my kids to say goodnight. You want to take over the call real quick?
Yeah, I can do it. Let's see. Let me share my screen.
All right. I'll be back in a couple minutes.
Wait, make sure I'm sharing the right screen and not my teleprompter. Okay. My computer's lagging because I got too much stuff going on. Let's try that while we talk about it. I'll take oh, fuck. I got kicked out. Maybe? Let's do this one. And I'll weight it against itself, or measure it against itself. Okay. So you're saying put them all in a sort function and then put Bill in there?
Yeah, that's what he was suggesting, but use moving average or return.
Okay.
Yeah, use moving average or cumulative return, and I typically use 20 days, but again, probably have to do different time frames: 10-day, 20-day, 60-day, and you know, spread them out.
Okay. Actually, let's get some older. What? I'm gonna add a few more in here. Say top. Did you say top moving average returns? %, drawdown. Okay. Have you tried this with like an inverse volatility switchboard? Oh, 36%. What's up, Financial Cloud? Cloud, I am now no longer in ATX. Wow, yeah, it does work a lot better than the static, the regular. So V1 hedge night is just the standard. It's just equally weightings. Um, the inverse volatility with a switchboard vastly outperforms that. Currently, I'm in Indiana, but I'm going to be moving in 85 days. Let's see. Standard deviation, it's got a little bit higher drawdown. It's not actually as good, calmer, but much more aggressive. You have any other recommendations, Hanon?
Can you hear me? My mic's kind of on and off.
Yeah, I can hear you.
Okay, good. No, that's one that I also picked up, I think, from the same paper that I put in the chat box, which it looks for like if you set up these filters right, you're looking for positive momentum as well as finding the best momentum of any of the sub strategies. So let's see.
What's the other one?
Let's see. You're doing inverse volatility right now. Okay.
Yeah, so I'm doing a switchboard of moving averages and then inverse volatility.
Oh, I see. I got you. Filter on a filter.
Yeah. Originally, I was doing drawdown as the top level filter, but inverse volatility seems to work really well.
Mm-hmm.
Let's try another version. So you said moving average returns, and what was the other one?
Well, I didn't see you construct that. Are you comparing those against Bill or USDU or something kind of flat?
Yes, so this one has got BIL. Yeah, BIL in it, more select than top
perfect.
2. Now, do you do as many bills as there is you're selecting?
Sure. Yeah, you could have it cut off completely. If you have 2 bills in there, then yes, then it can select bill twice to effectively cut off using any of the strategies. If none of them are, generating positive returns, then you can.
Okay.
It's interesting. I mean, that's certainly a game that you can.
It's basically like
play.
taking Derek's rotator from FTFL, but on like a higher level. V1.2. Let me add version 2 in here. So version 2 was the other rotator. Version 1's just the static. It looks like V2. It looks like it's better with only one bill. Let's do top 3. That'll be a 30 three-way weighting. So 2 bills and one asset or one strategy.
Yeah, it'll always let one strategy through.
Oh, that's way lower.
At 1/3 weighting, I guess. Yeah.
That really demolished.
Are you doing what he was talking about earlier?
Yeah, so I experimented with rotators with 2 bills. Let me undo that. And we were doing top 2. So with 2 bills, we're at V2.1. But did I close it? Where'd it go? Did I have it in the watch? So that's V1.1 is the static. V2.1, where's V2? Oh, is it just this one? And then we did the same one, but with only one bill. Like, so 50% bill, 50% another strategy.
So how does that work when there's 2 bills? Why is it different than if there's 1 bill?
It lets you cut off all strategies.
Yeah. Oh wait, I'm sorry. You're muted. Let me unmute you. I'm sorry. I forgot.
I was gonna say, it lets you cut off all the strategies. Like if none of the strategies are generating a positive return over whatever the window is, 20 days or 40 days, then Bill can kind of take over and just let you. It's like allowing it to be as protective as possible. It shuts off all the sub strategies, and you just swap in bill until one of those strategies starts generating a positive return again.
Sorry about the echo, Chad. Did that fix it?
Interesting. I never knew that about because some of them, I've seen strategies out there where they're the same ticker is there twice.
Yep.
And I'm going, why? But yeah, that makes sense.
What was
What
was the other indicator you said, Panome, that you like to standard returns, deviation?
No, that's the main trick that I was learning from some of these papers, was just like doing the dual momentum trick, where you're searching for the best return within the sub strategies, and then you're also comparing it with an absolute return from T-bills, or sometimes I've used the bullish dollar funds like UUP and USDU, and sometimes I get a better result out of those.
Let's try.
But you can't backtest those as far because they only go back to like maybe 2011 or 12, whereas this one you can go back to 2007.
You can do GLD. GLD is usually not a good one though.
Yeah. I'm a big fan of gold. Sure, no one ever went broke owning gold.
That's a good theory. Yeah,
you could smack somebody in the face with a gold bar.
That's right. You may not be able to eat it, but you can definitely defend yourself with it.
It has definitely had some drawdowns, though.
Yeah.
A little bit.
Yeah.
Especially if you go back to the 70s.
Again, you're comparing, like, if you throw gold in the group and you also put enough bills in there, well, it'll make sure that, if gold drops a lot, well, it'll just swap in bill.
That gold doesn't do too much.
Yes, instead of just having bill there, want to have a second sort function that looks at bill, commodities, dollar.
You could, right. You could have a little sub,
have a dual
filter that looks for the best of the non-stock,
It actually has a better. It doesn't have as much returns, but it has a much better calmer because the drawdown's lower. So gold is a good one. Let's run it back to. See if I can do this to 2008. 3.7. Yeah. UPro and Meta. Got some strategies in here.
I really wish they would put logarithmic.
Oh my god!
Option on the chart,
please.
Yeah, that would be really nice.
So frustrating.
There's a long list of functions I wish they supported.
I find myself grabbing that sidebar and sliding it just before 2020 so I can actually see what the graph looks like.
I mean, does it really matter? Because we're going to be billionaires with this. 3.5 billion. Or no, million.
3.5 billion. Quickly.
That's the goal, right? We're all going to just buy Composer.
Yeah. Very true.
Then they'll finally implement the stuff we want.
Yeah, that's right. It'll be a Composer takeover, and then we put in what we want.
And then the company collapses in a week.
Well, we'll have to figure out how to keep everybody employed. How to incentivize everybody to stay.
Just throw more money at
takeover problems.
The other problem so Brian, you mentioned a problem. The other problem is that your gold can be stolen, which the U.S. actually showed up with the Marines and literally stole the gold from central banks.
Well, I got these.
Yeah.
That was specifically in Haiti.
That's why you buy land and you bury it.
And don't tell anybody.
It's like real estate gold switchboard.
I don't remember the exact year, but yeah, the Marines showed up, stole the gold from the banks, and within a week it was in New York.
Sounds about right.
I wonder if they did something similar like that in Iraq. It didn't. Saddam Hussein had a ton of gold, right?
Yeah, There was probably a lot of confiscation there.
And I'm sure it was all above board. It was all,
Yeah, weapons of mass gold. All right. Cumulative returns is all right. You can't do it. Yeah, you can't do moving average price, relative strength index, standard deviation return.
Ton of banks went bankrupt because they were too heavy into gold during the gold standard. In fact, the sinking.
Wait a second. We can do percentage price oscillator rotation.
Indirectly led to the panic in 1857.
Have you experimented at all with the PPO?
Hey, when did that show up? That's new.
It's
because it's in beta still.
You gotta be in the beta group.
Oh, you gotta be a beta.
Just send a message to Donovan.
Yeah, I've done people that actually have it.
Right.
Yeah, I have.
I think maybe one solution is just to get everybody into the beta testers group.
Yeah, can we just have the Discord in the beta?
Yeah,
that'd be nice.
Problem solved. I have had trouble getting the PPO to actually do interesting things.
I have PPO in a few of my RFI strategies, and it does improve the returns. But it's not triggered very often, but it does work.
It's basically a Mace D, right? I don't.
Yeah,
it can be.
No, it is. It's pretty much the same.
Right, but with certain parameters, it's equivalent, right?
Yeah, because if you plug in MACD and then PPO on your trading view chart, the crossovers are the same. In other words, your buy signals would be the same.
That was not
there's
good.
There's two different PPO functions. One gives you a few more parameters.
Yeah.
Okay.
Smoothing window. No, those are all bad. Right. Yeah, terrible.
What are you trying to do? Oh, you're doing PPO?
I don't really know what I'm doing because I do we really know what we're doing? I feel like it's just a lot of.
You're doing a human Monte Carlo search.
I'll show you. It took me a while to figure it out, but I'll copy paste it into a new strategy, and then I'll show you what my screen looks like, or I can send it to you.
Let's try RSI.
This is gradient descent via bozos on a Sunday night.
Oh yeah, 2010. Okay.
Yeah, if you still have Bill in there and you're doing RSI, you might get some unpredictable results.
Yeah.
Because of the dividends.
Yeah, and just the fact that it's Bill. In other words, you're no good. Comparing relative strength of just the strategies in a way. Bill's going to kind of corrupt your results, I think.
All right, if you check the
you
check the chat, Garen, that's what the PPO should look like, or that's how you would code it.
Because
you have to do it in an uptrend, or otherwise it's going to give you too many signals.
Okay, so what if we did a longer window?
So the histogram has to be below 0. The 1226, the signal line. Yeah, so the PPO has to be below 0. The signal line has to be below 0, and then the PPO has to cross over the signal line below 0, and that would be the buy signal.
Okay.
So I'll show you what it looks like in TradingView.
Yeah, could you? Because I think this is what I was missing when I was trying to use PPO and failing.
Okay. Yeah, give me a second.
But I understand what you're saying.
That's actually better
to visualize it.
It's actually better than the static cumulative returns, or it's better than the static and the moving average returns weighted volatility. You just have to use a longer PPO, 1216 or 1260. with a 9 smooth. Let's do a 6.
1260.
Yeah, let's do a look back. So, yeah, it's way better. The volatility is crazy or high, way higher though.
Volatility, what's that? All right, so
Yeah, you're just gonna have diamond hands like Pietro's.
I noticed you still had gold in your list too, which is certainly volatile.
Did I? Oh yeah, yes. Right.
So Proteus, if you look at the chat, if you look at see the green dot on the crossover below 0, and the price action is above the 200-day, that's how it's coded into composer. So that would be your buy.
Makes a lot of sense.
Yeah. So basically, it's telling you there's been a pullback, and then the momentum has trended back upwards, and then you would go in.
Okay.
And MACD it does the exact same thing, doesn't it?
It can.
God.
With the right parameters. PPO is kind of like a more general function.
Okay.
MACD is like MACD. If I remember correctly, MACD is PPO with like specific parameter settings.
Okay. Yeah. See, they always confused me because on the chart they look exactly the same and they cross over in almost the exact same spots. Not every time, but a majority of the time, which obviously goes with what you're saying. If they have different parameters.
Yeah, I got to look it up to be sure, so don't quote me on that. But that's from what I recall. PPO is the more general one, and MACD is
the averages are the same
case. Yeah,
and the smoothing is the same. But I have seen instances where I'll stack them on top of each other, and the crossover on PPO would happen 1 or 2 days prior to the crossover on the MACD. But over 90% of the time, they cross over on the exact same day. But I like PPO because it gives you that big green dot at the crossover, and you don't have to freaking zoom in and figure out where they're crossing over, because sometimes you can't tell, they're so close.
Do you have the PPIO indicator for TradingView?
So yeah. PPO and MACD are basically the same thing. Looks like PPO just uses the moving average versus the longer moving average, but as a percentage, whereas the MACD is on an absolute basis. Essentially, you can plot it. Basically, the same thing.
Right.
Okay. So they're measuring the same thing, though?
Yep.
Yes, it's the same idea, yeah.
Okay.
You can technically just compare exponential moving averages, too.
Yeah, but you can't do the smoothing, which messes it all up. Because I've tried that. And it throws it way off.
The smoothing.
Yeah, the 9-day, they use a 9-day smoothing. They use a 1226 EMAs crossover, but then they smooth it out with a 9-day moving average. Am I understanding?
Oh yes, there is a second window filter. Yes, correct.
Yeah, so that's why that 1226 doesn't.
Right, that's for the signal line. Understood. Yep, there's a small difference.
Looks like
Gotcha.
the longer smoothback's better too.
So I gotta click on the screen. What are you plugging in? Are you plugging in PPO? Oh, you are plugging in. Okay.
Yeah, he's just adjusting exactly what you were talking about, which is that window of moving average they're using for smoothing.
How far?
But why? Yeah, why do you use that, Derek? Because that sort of delays. Doesn't it technically delay?
Quick question is like 12-126, are those kind of popular parameters for this indicator?
Sort of averaging more and more data.
Okay.
Yeah, they're popular.
Yeah, I've noticed just kind of seat of the pants. When you use
signals, I don't know.
Windows that are kind of popular.
Well, hold on, you guys are talking at the same time.
Sorry.
What were you saying, Dark Sage?
Sorry, I had Hinome muted, so I couldn't hear. But yeah, sorry. But what I was saying was, so you had the PPO. There's a signal line that exists there, right?
Yeah.
The question is, the more you extend the window, that signal line, the more in the past you're looking. You're actually looking older date. You're making a decision based on longer and longer ago.
Right.
How's the echo now?
Yeah, right.
Chat,
So you're
is
using
this
these
good?
exponential
Is the audio
moving averages
good?
to get very snappy responses, and then you have an adjustable moving period. So you can choose how much you want to be delayed.
But my question is that effective? Have you guys found that to be effective?
Oh, I see. You could compare it against a smoothing period of 0 to just eliminate that entirely.
Well,
Right.
what Dark Sage is saying is, aren't you sort of filtering out more opportunities by using a longer look back?
Right. It's a low pass
Exactly.
filter when you've got a very twitchy tool that you're using with exponential moving averages.
Yeah, that's true. I just use it in RSI strategy. So basically, if the strategy is inactive, it moves to looking for PPO signals and then takes the PPO trades if there's no RSI opportunities.
So these trigger when we hit green or hit red. How does that work with the logic in Composer?
Yeah, it works. You want me to send you the strategy?
Yeah, send me the strategy. I'll pull it up and we'll analyze it.
Okay. All right. They're few and far between, but they do it does yield a positive win rate, so that's why I put it in there. But it doesn't trigger very often. But it's nice because it triggers at times when the RSI is not triggering, and so I'm looking for other opportunities when there's no RSI opportunities out there.
I wonder if you could use like a super long PPO to measure like the send me the indicator on TradingView real quick and your strategy, Derek.
All right.
What I'm thinking is measuring the big movements on the like 3-year, 4-year charts of the SPY. So like the .com bubble and the housing market crash, like trigger it there and then switch to a bear strategy during that period. So the same way that you did Bill with moving averages with the 200-day, but use the PPO instead on that.
Right. So you use a faster reaction from the EMA comparison that the PPO gives you.
How do I send you the indicator from TradingView?
That's a good question. There should be a link. Let me pull up TradingView real quick. God, I gotta close these tabs.
Copy, hide, remove.
That's nothing, man.
Oh, you see all these over here? Every single one of these has just as many tabs.
Well, Garen, if you just go to if you just click on indicators and you just start typing percentage,
okay,
you'll see percentage price oscillator.
This one.
By Everget.
No, I have too many indicators going.
It's made by somebody called Everget, though.
Oh, this is BTC SPY.
And then I pasted the strategy in the chat.
Bitcoin. What we all really care about.
I just built a Bitcoin strategy that actually is doing pretty decently.
The pullback once the ETFs went live, and then there was a huge withdrawal of like $1 billion or $2 billion from the what was the Sam Bankman-Fried? FTX, right. Yeah, so they pulled out a huge amount of Bitcoins in the first week as ETFs went live. And all the Bitcoin stuff I had running has been crashing all of January.
It's temporary. You're right. They're trying to make all those victims whole or as whole as possible. So they're just diving in and selling all their Bitcoin. But I think it's
but now we're victims.
For the very short term.
I agree. Yeah.
Did fucking TradingView switch their?
Oh, speaking of that, there is a bit of news that you guys might not have heard. this has been going on so long that I'm hesitant to even believe that there's progress.
He's serious.
But it does look like the Mt. Gox release of Bitcoins might actually be happening soon. From that case, the trustee involved and the exchanges have started sending emails to all of the people involved in the case, trying to make sure everyone's got their verification ready and everything so that the coins can be distributed efficiently. And once that drops, it's going to be a very large number of Bitcoins suddenly becoming available to people who have been incredibly upset for 10 years.
Yeah, didn't it fold when Bitcoin was about $500 a coin?
No, actually, when the crash happened, Bitcoin had hit over 1,000.
Yeah, but it was just shortly after that, right? It was like 2014.
Chat, how's the echo?
And
does it
yeah,
sound
maybe
good?
it was close to 1,000, but still, relatively speaking, compared to 40K, they're going to have a lot of antsy people.
Yeah. I honestly think that was going to pay my way. That was going to pay for med school for me. And then nothing's crashed.
Wheat. You can
But
turn
that
on
is going to cause a dip in prices because there will be a lot of people selling.
So where Composer is limiting for the PPO is the way that I use PPO is, like I said, if it's above the 200-day, then you look at the PPO, and then when you get the buy signal on the PPO, you take a position, but then you have a take profit target and you have a stop level. You don't get that with Composer because there's no way to stay in the trade with PPO in Composer. At least I haven't gotten that far. You know what I mean? You get the signal, it goes long, but then as soon as the crossover parameters change, it goes back to bonds, even though the trend is still continuing to rise.
Wait. So they don't. So it only triggers for that day?
A lot of times, yeah, because if you look at the chart of the returns on Composer for the PPO strategy.
Yeah.
Damn it, I don't even have it pulled up anymore.
This one?
Yeah, if you zoom in, it looks like sometimes it's just in for a day. Can't really tell.
Let's experiment with it.
Put some ticker that's easy to track inside that function, so we can look at the historical holdings.
KOLV.
Oh, so you're doing. Oh, okay. So.
And I'll send the RSI strategy that it's a part of. That way you can see.
Let's do a really long look back. Got a lot of people watching on YouTube, but they're not talking.
The 12-day EMA versus the 252 EMA.
Awesome. Doesn't work. That's probably why it's in beta.
That's not too surprising.
Oh, dude,
because of the comparison you're making, not because the function doesn't work.
But curious, what do folks here consider as a good standard deviation to aim for in a switchboard? I've encountered and tested switchboards with over 150% AR and less than 30% drawdown over the last 5 to 6 years, but around a 50% standard deviation.
Okay, percentage price oscillator. Okay. I get what you're saying. So
Shub, I guess that's how you say your name. That depends on what your goal is for the specific strategy. I mean, if you have a 150% AR, a 50% standard deviation is probably just what comes with the territory. I mean, and I don't think there's a way around that. unless you pile on other strategies on top of that one to smooth out the equity.
So, Shub, if you go into the database, you can sort by standard deviation and then plot how they've performed out of sample. So you can look at the high standard deviation strategies that were known to be high standard deviation when they were posted and see how they've actually done since then. And what you'll probably find is that there's sort of a band of reasonable values that have really kind of outperformed over time. Like TQQ for the long term. Do you remember what the standard deviation is for that? I mean, it's relatively high than SPY, but
it's probably in the 40s, I'm sure.
Yeah. And that's understandable if you look at the logic and how it's performed.
Yeah.
But it's not claiming some, 10,000% AR.
Right.
And it actually seems to deliver what it promises. But a lot of strategies with high standard deviation are kind of just unpredictable. So
yeah,
SPY is what, 30-ish roughly most years.
No, I think it's like around. Is it that high?
It can be.
That's true. Yeah,
depends on the year. 2018 would be low. But from like 15 to 30, something like that.
Does standard deviation only measure the upside, or does it also
measure both? So it's the square root of the variance. So it's looking at both the upside and the downside.
It's indiscriminate.
Yeah.
It's like honey badger.
Which is kind of a problem because we do kind of care about the upside versus the downside.
Yeah.
Yeah.
That's why if you see me build switchboards with high standard deviation, the next level up is always drawdown, because like a 5-day look back drawdown, you don't, if stuff starts crashing and you've got a high standard deviation sort in there, it's going to select the most aggressive crash and burn.
Right.
You can mitigate that with a max drawdown function above that for the second layer of sorting.
And so you'll get a high standard deviation if you're crashing, if you're exploding, or if you're just noise.
Yeah.
And it's really important to be able to distinguish between those three possibilities.
Didn't you guys say that in order to sort of filter that, you can look at the strategy's Sharpe ratio, and then you look at the Sortino squared, and that will tell you which side of your standard deviation is heavier?
So yeah, if the Sortino divided by the square root of 2, which makes them comparable to short, if that is decently higher than the Sharpe, then yeah, you can know that because the Sortino is specifically looking at the downside.
Okay.
That can kind of that's one of the clues that tells you that your standard deviation is mostly on the upside.
But
you really you also need to look at other things. You need to look at your underwater play. You need to look at how long those drawdowns last. You look at your gain pain ratio.
So I made something, but I don't know how this works, but it's profitable. And it looks like it looks good. It looks
so what's this?
28% drawdown. It's the 12-day. I'm getting echo. 12-day over 252-day QQQ is greater than the 12-day over 26-day. I don't know what this means, but it works.
Can you put QQQ up there as your comparison?
Yeah, I was about to say that. I was going to say QQQ or VOOG.
By the way, Proteus, since 1999, SPY has a 19.6% standard deviation.
Okay.
But that's, start to finish, and I don't know.
Right.
Like you were saying, year by year, it could vary higher, right?
Right, obviously 2008, 2020, it's going to have a far higher standard deviation. But then that's all on the downside.
Right.
The SPY doesn't have a particularly high standard deviation
to the upside. Yeah. Okay.
It looks like we can only do 252. Look back.
So that being said, I'm going to go back to Shub's question. Thanks for the info. I will try out the database as Proteus and see how high standard deviation strategies have done post out of sample. Yeah, not a bad idea. But then again, I think you have to sort of naturally have, well, maybe not naturally, but comes with experience, I'm sure, to sort of take a look at the strategy, take a look at the logic, take a look at the back testing, and then you can sort of make an assumption as to, is the standard deviation happening more to the upside, or is it more to the downside, or is the strategy just way too volatile in general, and it's just there's a whole bunch of noise in the middle, like you were saying. You can do a cross up or a cross down in Composer by simple listing a specific current price. The problem with this is simple that you do not know the price until it happens. So if you're charting separately, you would be a day late on input of the price into Composer. By doing this, it is in for more than 1 day.
Yeah, I thought about that. And when Composer released their new API tools, I was really hoping that it'd be easier. But because of the way they make you do authentication, it's still like I had hoped that you could just make a script that would automatically update your strategies and adjust things like that day by day, right before the trading period.
Mm-hmm.
But it turns out to be a huge pain in the ass.
Wags, we can't hear you. Nope.
No, but you could sort of download the strategy and re-upload it to the console.
Right. I'm saying it's a pain in the ass to do totally automatically without human intervention. Doing it manually only takes a couple clicks, right? And that's totally doable, but you have to do that every day at just the right time.
No, well, why do you need any manual intervention? You would sort of on Selenium or whatever with your login token, you'd go in and it'd extract the particular ID.
I was going to say, try BTAL instead of SH for the bearish side of your strategy.
Yeah, I totally understand what you're saying, Hassan. And I agree that is theoretically doable. It's still a pain in the ass and kind of fragile.
Yeah,
maintaining an updated API token isn't so hard. It's long, like if you can do it once, you can update it every few minutes to make sure it's fresh.
you can do it through an extension.
Yeah. Right. You have to create that plugin though.
Right.
Like you'd have to do it as a plugin that has access to your user state. It might
go
easier to do as a script.
Now use the bottom RSI. Sorry to interrupt.
Can you hear me now?
Yeah, now we can.
Yes, now we can.
Okay. No, you guys were talking about a signal a while ago where you only get the signal in the day that you get the signal, and then it doesn't hold that signal for any period of time. Yeah. And so I'm playing with, it's like you have to reverse engineer stop orders, synthetic limit orders, crossing up, crossing down with the limitations of the composer. And so, yeah, one of my questions the other day was, if I go in and have a live strategy and I want to make some hard number changes in it, when does that take effect? Because I have to wait for the next trade window before that happens. And so, anyway, yeah, thanks.
Yeah, so you can get live data for free from Alpaca. And if you have a way to do it, you can get that. I mean, so the fastest you can update your strategy is right before the 3 p.m. New York time limit, where they start locking things down, which is still, 50 minutes before they actually trade. So it's not ideal to be working with explicit price thresholds. And that's as fast as you can go. and there are some serious hoops you have to jump through to get it done, and you have to do it every day. Like everything has to work every day.
By the way, what's the use case for this? The use case specifically?
Well, so they were talking specifically about using price thresholds, current price thresholds, and then having to update the threshold based on current information.
And those things are not capturable through the actual algorithm?
Well, the problem is staying in the trade. That's the problem, right? So yeah, the issue is we get the signal, we put the trade on, and as soon as the signal goes away, the trade comes off, or we go right back to ones, even though the price action is continuing to move in the direction of the trend, and all we're doing is using PPO as a buy signal, and then we're trying to ride the trend. The problem is the algorithm kicks us right back out as soon as the signal disappears, but we want to stay in because we already got the signal.
And since we don't have any,
There's nowhere to latch.
Yeah, and that's the problem. Because if you're manually
sticky.
Go ahead.
Sorry, you want it to be sticky, or you want to have memory.
Right. And these are simple decision trees.
Yeah.
And you can do that by just simply saying if it's above a specific price. If it's above that price,
yeah,
it stays in the trade. Yeah,
that's true. Yeah.
Right.
And in that case, you'd have to be modifying the strategy daily to make sure that you're entering the daily price, right?
That's the problem with the limitations of the oscillators and indicators in Composer. Yep.
Mm-hmm.
So the API does give you a way to update a strategy programmatically, but to do it within your user account.
I mean, at that point, if you can just export that to
right. Why not just do it on your own at that point?
Just fix the same thing. Yeah,
exactly.
Way easier, so much easier.
Well, the thing with doing the manual trade is you put the trade on when you get the signal, you set your stop, you set your take profit target, and then you're done. You don't have to touch it again, and it's going to stay in the trade. With Composer, you can't do that, and that's the problem, at least with the PPO.
Yeah.
Actually, I'm playing with a script now that you actually could, because if you're saying buy this above this price, okay, so it stays in that trade, and then you say when it gets to a higher price, go to cash. So what have you done? You've taken profit.
Yeah, true. But then you would have to liquidate the strategy after that, because if there's a reversal and the price comes back down within the threshold, it's going to throw you right back into the trade. So on the composer side, it's going to put you back on the trade.
Has anybody else tried using Berk A as a way to go directly to cash, since it's non-fractionable and you are probably not going to be able to buy a single share
unless you're Petros.
Unless you're Pietro, right.
It just destroys account.
I don't think any particular strategy he's running would meet the threshold.
Yeah.
Use BRKB.
Well, BRKB is fractional. BRKA is not.
Yeah.
Right. What Party is saying is you won't be able to afford the share, so it'll kick you to cash.
It's an indirect hack to actually get cash as an option for trading.
Hey, that's fine with me. Sounds good. I never thought about that. I want to go to cash. How will they make me go to cash?
But what does the backtester do? Does the backtester actually fraction it anyways?
That's a good question. So I've talked to Brian, one of their devs, about this, and they wanted to add some better code to model fractionability, and now that they've added Apex, Apex has different fractionability rules.
The backtest,
whatever the fractionability rules are, Borg A is not fractionable on any
the backtest does keep you in cash. If you enter $100 as the investment amount, and you put in BRKA, it keeps you in cash in the backtest.
Yeah. Right. So it does work.
It does work.
It's a very unique case.
Well, it's so that it keeps you out of the club unless you can afford the one share, but that way you can be invited to the annual shareholders meeting.
Oh no, you could definitely be invited to the shareholders meeting at Berk B. Most of all.
Oh, you can?
Oh yeah, I go.
Okay.
It's down the street.
Oh, lucky you.
And then once it's over, what else is there to do?
Not a whole lot. There's some great restaurants.
I'm just kidding.
No. You're actually totally accurate though. There is not a lot to do.
Right. Yeah, I've heard you talk about it. What is the What's the How come I can't talk? What drives the economy of Nebraska? Corn?
It depends on which part you're talking about. So Omaha is almost like a totally different state.
Oh, okay.
Right, because that's where most of the people live.
Yeah, right.
And but the thing actually driving the economy is very different there than it is in the rest of the state. Yeah, so corn, soybeans,
agriculture in general.
Right, agriculture is a big deal. Actually, marijuana is probably the largest cash crop.
Oh, really?
Probably. The conditions are perfect.
Wow, well, that's nice.
Well, I just mean because it's worth so much per pound, so it ends up probably beating corn. But yeah, it's not terribly exciting until you get to Omaha. But like it's almost like a city state that's like trapped within this larger system, and there isn't a whole lot of connection to the rest of anything around it. So much of Iowa is also rural, but yeah, I mean the capital and like there are lots of states where you basically have two cities and then everything else. And a lot of the economy is coming from the rural areas, and the other half of the economy or more is coming from the cities, and they don't have a whole lot in common. It's because the money's coming from very different sources.
You want to take back over, Derek? I gotta eat.
Sounds good. Do you guys have anything that we should look at, or anything you want to bring up? Any new strategies? Oh, let me check that.
I'm actually very curious about that question because I've been out of the loop for a couple weeks.
Yeah, how long have you been off?
Last night briefly and today, basically. There have been a couple points where I've gotten a ton of DMs about server drama, and then I just kept putting people on mute because I just had too much stuff going on. So this is the first time I've actually tried to catch up.
Well,
so I'm curious if there's been any good strategy that popped up.
Ryan E shared something recently. Let me see if I can find a link to it.
Okay.
It was in the dumpster fire.
I got my Bitcoin strategy that I posted. That's.
Oh, where's that at?
It's in the Symphony sharing. Pull it up.
Let's look at those two. There's actually one from Derek that I noticed one night when I was just like casually scrolling. You posted something that was just an amalgamation of various ideas you had, and each chunk of it was sort of a simple little bit of logic in different domain and some other currencies or commodities. Let me see if I can find it quick. I don't remember the name. But I thought it was interesting. Let's see here.
Was it the RSI or die, or was it something else?
I don't know. It was.
Okay. Yeah, put it in the chat. 520 Bitcoin ribbon.
Yeah, it's literally just I used a ribbon to lower the volatility, and then I threw BIOWRECKED in there, and I also switched BIOWRECKED to a ribbon as well. And you got to share your screen.
Oh, my bad. Forgot.
Yeah, BIOWRECKED. If you switch, that's where I got the idea of the ribbon, and it works really well with BIOWRECKED for some reason.
Is so crazy. I can't like I thought at first it was like a joke, and then you guys actually ran it and made a ton of money on it. And I was like, what the fuck?
Yeah, it's up like 250% in my first portfolio.
That's funny. Okay, so this is 5-day EMA of BITO is greater than a 20-day EMA of BITO. Go long Bitcoin, and then if not, he uses the BIOWRECKED 9
and you
9-day moving average. Oh, and 25, like you were saying earlier.
Go ahead, isolate that one real quick. Pull the BIOWRECKED one out. Just put it in a new symphony.
Okay.
It's the next YouTube video. I built it in the YouTube video, but I'm waiting on the thumbnail artist to send me my thumbnail.
Okay. 24, 63.
The Tom Basso 27 digit is the one I was thinking of.
Oh, okay. Yeah, I'll take a look at it after this one. All right, so this is 9-day move average of SPY greater than 25-day. Oversold.
Everything's the same. The only thing I switched was that ribbon.
Oh, the up here, the 9-day?
Yep.
That's actually kind of nice because then you can do the short term trade in the short term and not have to wait on these longer dated signals. What was the one before? Was it just the normal 200-day move average one?
Yes, I believe so.
Okay. Let's go to 2011. So everything else is the same. It just uses it uses the ribbon instead.
Yeah. I actually didn't compare it against the regular BIOWRECKED. You might want to do that.
Oh man, I'm gonna have to search down in the depths of my
drafts
page.
The reason I switched, I was experimenting with a ribbon is to a lot of the FTFL variants. They're really great unless there's chop above the 200-day. So like there's not a whole lot of logic above 200-day. And we had that temporary pullback like 6 or 8 months ago where a bunch of people were losing money, but it was because they jumped into the BIOWRECKED. They jumped into the FTFL, like those huge snapbacks right there. I was trying to smooth that out.
Gotcha.
Do you recall what the date was when Composer added the sort functions, filters?
It's like 5 months ago, somewhere on there. Was it September? I thought it. Okay. I'm absolutely terrible with dates.
Yeah, me too.
Yeah. Wait, is this not going back far enough? Oh, whoops. My bad. $84, 46. Oh, slab view only goes back to 2015. Yeah, so we go Okay, here it is. All right, so this one, and then add BIOWRECKED to the chart. Is that what you're saying?
Yeah.
Too many copies of BIOWRECKED. So the only difference is the moving average, right? The 9-day.
Yep.
Yeah, so here they diverge. No, it just seems like with the new one, it just gets in later, basically, right? Because of the moving average.
Mm-hmm. Yep. The main focus was just to use a ribbon to get Bitcoin exposure, but then just rotate into whatever strategy you want. It doesn't have to be BIOWRECKED; it can be anything.
Yeah, gotcha.
But Bitcoin's so volatile. It has a very unique pattern.
Yeah. True. Tom Basso. Okay, yeah, I remember now. Describing Rentec, Proteus. Yeah, it's similar. All right, Derek, this is what I was trying out. Sorting function over a HOPQ for the long-term BWC mod and an IRA one from Rogan, I think. Pretty high standard deviation, but very decent annual return and drawdown. Well, it's only a 2019 backtest too, though, so that's already a problem. If you're looking at
before 2019, I think the FNGU wasn't there, so it kind of makes it difficult.
Gotcha. Okay. So the problem is if you're going to look at standard deviation and you're trying to figure out, okay, how reliable is the strategy or whatever. The problem is it may have a standard deviation of 50, but you're also only going back to 2019. So 2019 was a really good year overall for stocks in general, and then 2020 was a good year. 2021 was a really good year. These are like consistently high returning years anyway. And then 2022 was a major down year, but standard deviation through all 4 years is going to be really high. So this is going to change. Likely, it's going to be likely to change. Basically, it may go down, it may stay the same, and it may go up. But this doesn't necessarily tell you that this might be too much risk to the downside. This is more than likely the upside profitability of it because we had such good years the last 3 or 4 years. So because you have for the long term, which did astronomical returns 2019, 2021. Oh, I'm sorry, 2019, 2020, 2021, 2022, and 2023. So that's going to have an extremely high standard deviation over the 4 years.
Yeah, I was looking at the Four Horsemen one. I think it was also having about 55, 60.
Okay,
and that's a mixture of 4 TQQF elements.
Yeah, I remember that one. I think I still have it. Now, does that one? I think that one also only goes to 2019, right?
It goes back. I think it goes back till 2013. So. Or
Okay.
2012.
All right. Oh yeah, that's right. It looks like I only did the longer backtest versions in here.
Yeah.
Okay, so this will give you a more accurate representation of what the true standard deviation will be, at least for the long term, because these are very different variants of the same strategy. But yeah, so 50%, so that's probably good, or reliable anyway, for at least for that one. These ones, I don't know what they are, so
Yeah.
I can't really say. But you would look at it,
Looks like
right,
Brian
and
E's.
get a good feel.
I think it's Brian E's.
Say it again.
I think it's Brian E's logic. I thought it looked like a pop bot.
Okay. So Vixie, overbought, Vixie.
Here I've changed. I think the original one used UVix and SVix, but I ended up changing all to Vixie or SVXY because those were crazy.
Yeah, that makes sense. 10-day QQQ. Okay, so these are oversold conditions. Oversold. Black Swan Catcher. Vixen above 80. So these are, at least for this portion of the strategy, these are going to be the more rare occurrences. So these might only happen 1, 2, maybe 3 times a year, something like that. Especially this Vixen above 80, that's going to be pretty rare. So that might, and these are going to throw off the standard deviation probably by a lot, just because when these jump, they jump high, and they don't jump very often. But the majority of the strategy is probably going to be somewhere down here, I would assume. 4-day max drawdown of short, less than 0.1%. RSI for the long term, bonds momentum. 10-day RSI of TMF, less than 32, so oversold on TMF. 126-day RSI of TLT greater than 50, TYD or TYO. For the long-term logic, 63-day RSI of XLK greater than 63-day RSI of XLU. Okay, so this is basically just a big RSI strategy. This one would be hard to tell. This one I would run through QuantStats. The IRA one. Because you could get a lot more data running that one through QuantStats. Yeah. Give you more of an idea.
I ran through QuantStat. It was like one period was having a max drawdown. Like the 28% max drawdown was like 197 days. Everything else was smooth. And that 197 days, that was very, that would have been painful.
So that was an outlier.
Yeah. But that was also like starting of 2019, I think it was, and it was pretty bad.
Which is fine.
But when I was looking at month-to-month return, it was like from next month onwards started trending positive. So I think if somebody was riding it, it would have been okay.
Yeah, and that I wouldn't worry about too much, only because if you look at SPY, it's heading the same direction. So, in other words, if the strategy is more or less correlated to SPY, which it looks like it kind of is, other than it's a little more, it's just more leveraged, and then it's got the mean reversion stuff. But when SPY is up, the strategy's up. When SPY is down, the strategy's up. But there's, in the up periods, they're correlated, and then in the down periods, obviously they're uncorrelated. But like this, I wouldn't even, and like you're saying, in the quant stats, that's the only occurrence that you see. And then everything else is, what was the other drawdowns besides that one? What were the worst ones?
I don't remember exactly, but others were not bad, like 30-day, 40-day, not too bad. It was like percentage-wise, it was like minus 10%, 15%, but the minus 28% one was pretty bad. But it's also going only till 2019, I guess. To see like what I can use to backtest FNGU, FNGS, these kind of tickers. I haven't figured out that part yet.
Yeah, those you're better off just deleting them, because there are none that go back further, at least not that track the FANG index. So your best bet is going to be TQQQ, TECL, SOXL, but they're not going to be. They'll be close, but they're not exactly the same. They're probably, yeah, they're probably maybe 90% correlated or 85 or something like that, but they're going to be very close. But that being said, obviously there's a lot of VIXY, there's a lot of leveraged ETFs, there's a lot of aggressive stuff in this strategy. So the standard deviation, yeah, I would say this is probably pretty accurate. Was that your overall question earlier? You were asking about that, right?
Yeah, to some extent, but I've seen others also. Like I was seeing with Four Horsemen, if you add a filter on top of it with RSI, then you can get even better return, but with slightly higher standard deviation. So I was just trying out stuff. But yeah, that answers my question. I'll keep trying.
Yeah, that makes sense. And the filters are good. I mean, like, let's say if you want to run a strategy like TQQQ for the long term, I mean, you can run, like you were saying with the Four Horsemen one, you said you filtered them instead, right?
Yeah, yeah, exactly. Okay. If you filter them with RSI 10-day and choose the bottom two, like, so which was performing bad in terms of, and then it gives much better returns and less drawdowns. But compared to 55% was like 60% distribution.
Yeah, so the standard deviation goes up, but then you have higher returns and less drawdown.
Less drawdown as well. Yeah.
Yeah. There's going to be trade-offs. But if I let's say I look at this, right, and this is just the equal weighting, 183, a 2.3 Sharpe ratio, 45% max drawdown, and then a 50% standard deviation, and then I run this through a 10-day RSI filter, and I see higher returns but a higher standard deviation, I would probably just say, nah, screw it, I'm going to stay with the equal weighting. Because if the standard deviation is going from 50 to 65, you said?
Yes.
Okay.
But with less AR, like less max drawdown. Yeah.
Gotcha. Okay. Yeah, I mean, I guess there's nothing wrong with that other than you have a higher standard deviation, which may or may not get you in trouble. I'm not really sure. And honestly, probably where that's coming from is the fact that this one measures 200-day move average, whereas this one only measures 20-day. So that's probably where you're getting the uptick in the standard deviation from. Because if you look at this one, this is only a short-term strategy. So it doesn't care about the 200-day. It's only looking at the 20. So this one's going to be more volatile because you're going to have more whipsawing. Let me get BIOWRECKED out of here. So this one may have more reliable periods at certain points, but then the problem is you're going to have see this right here, how it's continuously going down, down, down. This is where that price is closing above the 20-day, back below, back above, back below, and you're getting whipsawed. And as you're getting whipsawed, you're incurring more drawdown, more drawdown, more drawdown. So a strategy like this one is what's going to add to that standard deviation. But the trade-off is like here, where this actually does better than the 200-day one. If you look at let's see, for the long term, spell it out. Oh no, my bad. So if I compare the two, see that? See the divergence? So this one is more reliable and less volatile, but this it's temporary. You know what I mean? So there's times where the 20-day will do better, but then there's times where the 200 will do better. But they're both good. You know what I mean? Like there's another divergence there because one is long-term trend following, the other one's short-term. So they're not always going to look the same. There's another divergence. But anyway, it looks like that's where the uptick in the standard deviation comes from, at least when you're filtering that one.
Yep.
Because there's going to be times, obviously, where it's only picking the 20-day SMA and running that one by itself, and then it's transitioning back to the 200-day and so on and so forth. But yeah, these, I don't know enough about these two because I didn't make these two, and I think this is the first time I've seen them. But just looking at the amount of leverage and stuff that's in them, it's no wonder why the standard deviation is so high.
Like all the ones are strong out, but not so. Yeah.
But if it's something you're comfortable with, then yeah, I mean, run it. Are you trading this one live or no?
No, I can't really trade live. I'm in Canada.
Ah, that sucks.
Yeah.
Well, sucks and
yeah.
you can't trade. Do you?
I'm gonna try them out with IBKR. So I have all three of them partially. Like I have them coded in Python separately. I'm gonna see if I can test them out live. I have to create the standard deviation function, like sorting function, over these symphonies. That part I have to still see. But,
okay. Are you gonna trade on the? Are you gonna trade on the same time interval?
Yes.
Gotcha. So you'll be trading in like the last 10 minutes of the day or whatever?
Yeah, last 5 minutes, like whatever I can.
Okay.
Even more closer to closing date.
Gotcha. All right, I'm gonna look at this Tom Basso 2007 one. Yeah, no problem, dude. Thanks for actually participating.
Backtest on this one looks really clean.
Yeah, this, okay, yeah, I do remember this. So what I did was, based on what he was saying about, trying to think back to the video. So he interviewed with Trader Lion, and I played the video on one of the calls. But basically, his nickname is Mr. Serenity, and so what he was saying in the interview was every trade that he puts on has the same significance as other trades. In other words, if I'm trading a DBC 9-day EMA, it's got the same significance as this strategy here. So all I did basically was take a bunch of different strategies that are uncorrelated to each other, and I just equal weighted them across the portfolio and then ran them. And I think I purposely picked ones that you could test all the way back. So they're pretty much all uncorrelated, but in some way they do have correlations too.
So I don't know if you saw that paper that I had open earlier. I did a fuck ton of tests with, well, let me just pull it up. I'll share it with you. So I tested every single metric for sorting algos. So like you're basically what you just had. I tested the bear markets, bull markets. Like here's the time frames that I all tested to see like what's the best sorting functions. And if I remember overall, where's overall at? September 4th, bear markets, alt, best AR, annualized return. If you want to, you can experiment with standard deviation returns, bottom 252, and you should get like a crazy low drawdown with all of those algos if you want to put them into a sort function instead.
Oh, the ones that are in that Tom Basso one?
Yeah. And also, I just experimented with the Tom Basso. If you want to pull your go back to your window.
Okay.
If you switch, I tried to do inverse volatility, switch that weighting to inverse volatility, but it's just flat for some reason.
Because there's a lot of, I think because there's a lot of treasury bill holdings in here, and there's times where, because most of these, if you look at them, go back.
Lot of bill.
Yeah, they're holding because they're only using one signal basically. So if commodities are not trending, it's going to stay in treasuries.
Okay.
So that's one example. QQQ, not so much. That one is a trend following. That's trend following. This one, same thing. This one's trend following, but if it's not, it's just in treasuries. So it's literally either in TLT or SHV. So I think that's why you're seeing the flat.
Okay. Have you
see what I mean?
Have you tried to do these with the switchboard?
No, I don't think so. When you guys say switchboard, are you talking about like sort function?
Well, switchboard to me is a dual layer sorting, or sorting is just one sort, but switchboard is sorting inside of sorting.
Okay. Yeah, I don't honestly. A lot of times when I'm sitting there and I'm trying to I'm putting something together, I'll use like a sort function and I'll put in groups under a sort function. But then when I start trying to do sorts within sorts, my fucking brain just melts down, dude, and I just short circuit and I'm like, what am I doing?
Well, Composer also doesn't give us the tools to really see what's happening. So throwing everything into a blob like this, where it's all equally weighted, is fine. And I mean, if you look at the standard deviation and the max drawdown, I mean,
yeah,
this is on average median SPY with a far better Colmar, far better. I mean, like it's pretty decent, and it's a very different design than most of the stuff that I've seen posted. So this really caught my eye.
Yeah, well, this is
the switchboard stuff. Like we could put that on top of this.
Yeah, yeah, right. And these are all strategies that have existed for a long time. I mean, I'm trying to think of like that one I made a long time ago. That I made a long time ago. This is fairly recent. That one I made a while back. That one I made maybe 6 months ago. That one I made probably a year ago, probably 6 months ago. This was one of the first strategies I ever made. And then the DBC, I think this was within the last couple of months I made that one. But because these are all singular strategies that can be run on their own, I lump them all together based on the way Tom Basso was describing how he trades his portfolio. So not only is it every trade gets the same amount of importance across the whole portfolio, they all carry the same significance. But not only that, his nickname is Mr. Serenity because the way that he trades is he trades extremely low risk. So in other words, he might risk maybe 0.1% of his portfolio per trade, whereas most traders will risk anywhere from 1 to 3% of the total portfolio on each trade. And so the way that I picked these was these are very vanilla sort of strategies. And so I figured, well, if I lump them all together, most of the time, most of them are going to be in treasury bonds, and they're just going to be waiting for signals, basically. So they're not going to trade that often, except for maybe a few of them. Like this one will trade a lot. What more do you need? That'll trade a lot. But that will trade rarely. That'll trade rarely. Commodities will trade rarely. US dollar will trade rarely. Gold, XLP might trade medium. This one will trade a lot. This will be rare. This one is always in the market, and then this one is rare as well. So by lumping them all together, I'm sort of looking for that serenity score that he's known for, and then so if I copy it and run it through QuantStats, I should have a fairly high serenity. Is it index? Serenity index?
Ratio.
Yeah. So let me run this real quick. And then if you wanted to even, because basically, like, if you wanted to maximize your serenity ratio, you could basically just buy and hold treasury bills, right? And you'd have like a 2,000 serenity ratio or whatever it is.
To some extent, so that will take care of the drawdown side of it, but the serenity ratio is also increased with upside gains.
So if you look at this compared to SPY, 21 versus 0.62, and this is since 2007. So to have a consistently high serenity index, and then even the ulcer 0.02, I don't even know if it goes any lower than 0.02.
I'm not sure it really needs that much when you get to the extremes.
Okay, true, yeah. But if you wanted this to jump, let's say to 80 or even 100, you basically just come over to the strategy and you group all these together, and then you just put a heavier weighting in buy and hold SHV. So here, let's see. Let me create a group. I'll throw these all in a group. And then I can delete. And I was just trying to achieve kind of what he was talking about as far as like filling in the potholes of your equity curve and that sort of a thing. So if I go here, I weight SHV, and then I turn this to specified. And let's say I do the group 45, and then I weight treasury bills 55%, and then save it. And then I rerun it. I want to see what it does to the freaking serenity index. But that's all I was trying to do with this one. Now, the nice thing is, well, here let me look at this first before
we could really replace Bill with something like this. If we weren't restricted by trading fees and wash sales and slippage and all that.
Yeah, you're right. Serenity, so it doesn't go up much, but
it's not a huge difference.
Yeah, and it's such a long period of time. I think that's why, because there's other ones where
now the ulcer does go down. It's half of what it was.
Okay, all right, so that's good.
The ulcer is part of the serenity formula.
Okay, which makes sense. I mean, the two words are literally opposite, right? So, if you look at, oh, that's what I was going to say. So now, if you take this group and then you say, okay, I can switch every one of these to leveraged versions or whatever, you can still have decently high returns with relatively low drawdown, you know? Like some of the, I'm trying to think back to some of the, let me go to this RSI or die.
Derek, do you remember the Rentec strategy that you made?
Yeah.
Because it's basically the same exact idea, just with leverage.
Okay, yeah, you're right. Let me go to Rentec. Okay, 10-day RSI. I just have to make sure there's nothing in here that's like secret or whatever. I don't think there is, but let me run this.
If it is, you already made it public. So.
Yeah, no, this is all just
Whoops. Like, no, I mean, like, I already have a copy of the strategy because you shared it in another call.
Oh, okay. Then then there's nothing in here that's secret then, because if you already have a copy, then I already made sure that there's nothing in there.
I just had to strip out the PPO.
Right. That's okay. I remember now. Okay, yeah. So if I run that, the Serenity should be super, super high on this, but not a very long backtest either. And you're right. That is what I was trying to do with this Renaissance Technologies one, was clump together. Yes. Yeah. And there's ones I've seen that have been like over 300, and then if you do buy and hold treasury bills, it's literally like over 2,000. But there's basically zero risk. But this one, the same concept, because I was trying to take the approach of, okay, so Renaissance, they have a bunch of different strategies that they run, and they're all automatic or whatever. And so if I just start plugging in a bunch of different strategies that are standalone strategies, and they're all doing different things all at the same time, can I achieve the same kind of result, basically, is what I was testing. And so this, I don't necessarily care much if it's I don't care too much about like the annual return and all that. What I'm looking for on something like this is, how does it behave in specific periods? Like, does it, if the market's turning down quickly, is the strategy quickly following the market, or is it sort of kind of pulling back and going the other way? And it's kind of pulling back and going the other way. And that's kind of what I was trying to see if it would